If you've been waiting for mortgage rates to finally break their current cycle, you aren't alone. For the past several weeks, mortgage rates have been stuck in a narrow range, hovering stubbornly around 6.5%. It's been a frustrating time for homebuyers and those looking to refinance, but there's a new development in the global market that could change the math. It all comes down to oil. We've seen a significant amount of volatility in mortgage rates recently, largely driven by the conflict in the Middle East. When geopolitical tensions flare, oil prices often spike, which fuels inflation concerns. Since mortgage rates are tied to the 10-year Treasury yield, that inflationary pressure forces rates to stay higher for longer. But here is the breaking news. Oil prices have recently begun to pull back. As negotiations and shifting global conditions ease some of the supply concerns, energy costs are finally starting to cool off. Why does this matter for your home loan? Because energy prices are a massive component of inflation. When energy prices fall, it signals to bond investors that inflationary pressure might be easing. When those investors feel more confident about long-term stability, they're more likely to buy bonds, which pushes yields down. And when yields go down, mortgage rates often follow. However, we aren't out of the woods just yet. The Federal Reserve is still keeping a very close eye on the economy. While lowered energy costs are a win for consumers, the Fed is looking for a broader trend of price stability. They've hinted that rates could stay elevated if the labor market remains too strong, or if inflation doesn't move back to their target. So, what should you do if you're currently in the market? First, keep your eyes on the daily 10-year Treasury yield. That is your canary in the coal mine for where mortgage rates are heading. Second, don't try to time the market